If you've ever heard someone say, I want the upside of the stock market, but I don't want to risk losing money when it crashes, that's exactly the pitch behind Indexed Universal Life Insurance, or IUL. It sounds almost too good to be true. So today, let's break down exactly how it works and then walk through the real pros and the real cons, no sales pitch, just the facts so you can decide if it actually fits your situation. An IUL is a type of permanent life insurance. That means as long as you keep paying the premium, the coverage lasts your entire life, unlike term insurance, which expires after a set number of years. But the part that makes IUL different is the cash value account attached to it. Instead of earning a fixed interest rate, your cash value growth is linked to the performance of a stock market index, usually something like the S&P 500. Here's the catch, though, you're not actually invested in the market. The insurance company uses your performance as a benchmark to calculate how much interest to credit your account, and that calculation comes with two important limits, a floor and a cap. Let's talk about the floor first, because this is the main selling point. Most IUL policies guarantee a 0% floor. That means if the market crashes, say it drops 20% in a year, your cash value doesn't lose a dime. You simply earn 0% that year instead of going negative. That's real protection. Your account never loses money due to market downturns. It's one of the few financial products that can say that. Now here's the trade-off, the cap. In exchange for that protection, your gains are limited. If the cap is set at 10% and the market index actually returns 25% that year, you don't get 25%, you get 10%. The insurance company keeps the difference to pay for that downside protection. So in good years, you're sharing the upside. In bad years, you're shielded from the downside. That's the entire mechanism in a nutshell. Let's go through the real advantages. 1. Downside protection. As we covered, the 0% floor means market crashes don't touch your principal. For risk-averse savers, that peace of mind is valuable. 2. Tax-deferred growth. Your cash value grows without being taxed year to year, similar to a retirement account. 3. Tax-free policy loans. You can borrow against your cash value, and if structured properly, those loans are not taxed as income. Many people use this as a tax-free income stream in retirement. For a permanent death benefit, your beneficiaries receive a tax-free payout, which can support a family or cover estate costs. 5. Flexible premiums. Unlike whole life insurance, IUL often allows you to adjust your premium payments within certain limits, which helps if your income fluctuates. 6. No IRS contribution limits. Unlike a 401k or an IRA, there's no annual cap on how much you can put into the cash value, which appeals to high earners looking for additional tax advantage savings. Now, let's be just as honest about the downsides. 1. Capped returns. In strong market years, you're giving up significant gains. If the market returns 20 to 30%, you might only capture 8 to 12%. 2. High fees. IUL policies carry the cost of insurance, administrative fees, and sometimes surrender charges if you cancel early. These fees can quietly eat into your returns, especially in the first several years. 3. Complexity. IUL is genuinely one of the more complicated financial products out there. Caps, floors, participation rates, policy charges, it takes real effort to fully understand what you're buying. For lapse risk. If you don't fund the policy properly, or if you take out too much in loans, the policy can lapse, and if that happens, any outstanding loan balance can suddenly become taxable income. That's a costly surprise for people who weren't expecting it. 5. Optimistic illustrations. Many IUL sales presentations use historical averages or best-case projections that don't always reflect real-world performance. It's important to ask for conservative, guaranteed minimum illustrations, not just the rosy ones. So, who does IUL make sense for? Generally, it fits people who've already maxed out their 401k and IRA, want permanent life insurance anyway, and are looking for an additional tax-advantaged bucket, especially higher income earners who are risk-averse. It's usually not the right fit if you're early in your savings journey, need pure investment growth, or can't commit to funding the policy long-term. At the end of the day, an IUL isn't good or bad, it's a tool. Used correctly, it offers real protection and real tax advantages. Used incorrectly, the fees and complexity can work against you. The key is working with someone who shows you the full picture guaranteed minimums, not just the best case numbers, so you know exactly what you're signing up for. Please like and share.